Covered call funds have become popular in recent years as investors look for higher yielding investment strategies to add to their portfolios. These funds involve selling call options on an underlying portfolio in order to generate premiums. A call option gives the buyer of the call the right, but not the obligation, to buy a security at a fixed price during a specified time period. For example, a call buyer could buy an option on a stock that is currently trading at $100 that gives her the right to buy that stock at $102 over the next month. For this right, the buyer would pay the seller of the call a premium. If the stock is trading over $102 at expiry of the option, the call buyer would exercise the option and the call seller would be obligated to deliver the stock at that fixed price. Regardless of whether the option is exercised or not, the seller of the option gets to keep the premium that was paid. A covered call strategy involves investing in a security and then selling call options on that same security at the same time. This combination of a long position in a security and a short position in a call option on that same security that make up a covered call caps the investor's upside at the strike price in exchange for the option premium. Broken down into its components, a covered call provides the investor with long equity exposure and short volatility exposure to the underlying security. In the case of a covered call fund, the premiums received can be used to supplement dividends on the portfolio holdings, and these funds often pay out higher distributions than would otherwise be possible. A good way to look at an option contract is to think of it as a financial insurance contract. Just as in the case of an insurance provider, an option seller brings in premiums in exchange for a liability that pays out based on certain future events. In this case, the movement of the underlying security. Similar to an insurance company, net profitability of a covered call strategy depends on whether the premiums received are enough to cover these eventual payouts. In the case of equity markets, option sellers tend to be compensated by the volatility risk premium, which is the phenomenon that option-implied volatility tends to exceed realized volatility of the same underlying security over time. Covered call strategies allow a fund to generate premiums that are received when selling call options, which reduce the volatility of the portfolio and often allow the fund to pay out higher distributions than it would otherwise be able to do. Relative to a traditional long-only strategy, certain covered call strategies can have several benefits for an investor. These include lower volatility, higher risk-adjusted returns over time, outperformance during flat markets, lower drawdowns during volatile markets, and the potential for higher distributions. When looking at covered call strategies, we believe it is important for investors to realize that not all strategies are created the same. There are several key decisions a portfolio manager must make when designing and executing an option strategy. The most notable consideration is the moneyness level at which the options are written. For example, a portfolio manager could write options at the current trading price of an underlying security, known as an at-the-money strategy, or at some price above the current trading price, known as an out-of-the-money strategy. Changes to various options parameters can have a significant impact on the risk-return profile of a covered call strategy. For example, simply changing the moneyness level at which calls are written will impact the amount of option premiums received, with higher premiums received for an at-the-money strategy relative to an out-of-the-money strategy. However, these additional premiums do not come for free, as the investor still needs to consider the corresponding liability for the obligation to deliver the security at a fixed price in the future. This liability is higher in the case of an at-the-money strategy, which caps the upside on the position at the current trading price, while an out-of-the-money strategy will allow for some participation in the upside. A common misconception among covered call investors is that more premiums lead to higher distributable income with no downside. However, generating higher premiums by writing closer to the money also means sacrificing more of the upside if markets move higher, which can reduce total returns. Just as a company cannot sustainably pay out more dividends than it earns in income over the long run, an investment fund cannot continue to pay distributions that exceed the long-run total return of the strategy without eventually eroding its net asset value. While future returns are mostly unknown in investing, We believe that funds whose strategy is to write at-the-money calls and pay out all of the option premiums as yield run the risk of a declining net asset value over time, as these strategies fail to consider the future liabilities that come alongside the premiums. This does not mean that covered call strategies cannot be used for income. In our view, by reducing the volatility of the portfolio, covered calls allow the portfolio manager to become more confident in paying out higher distributions because there is less variability in the future returns. However, we believe the portfolio manager must consider the long-term total return potential of the strategy when it's setting its distribution policy in order to avoid the risk of overpaying in the long run. To put this in context, if a covered call fund is paying out a 15% distribution and the long-term total return of the strategy over 5 to 10 years tracks to 8%, then paying out that 15% per annum distribution will result in an eventual decline in the net asset value by approximately the amount of the overpayment. Our research shows that covered call strategies can provide investors with attractive risk-adjusted returns over the long term across many different market environments. Covered call strategies typically work best in periods of moderate to high volatility, while they tend to underperform the market on an absolute basis during low volatility bull markets. Brompton's covered call funds take these factors into consideration and allow us to increase our overwrite levels during periods of elevated volatility, while dialing back the program in lower volatility environments in order to participate in strong markets. Visit bromptongroup.com/covered calls for our full lineup of covered call funds.